Hello, welcome back everyone. So today we're going to be talking about breakouts and impulse entries. Before we start the lesson, I want to thank RajaBanks and Market Fluidity for allowing me to do the lesson on impulse entries. Without them, that wouldn't be possible. So I'm going to leave their link and information down in the description for the Instagram, the YouTube channel for Wicksdontlie, and the Instagram for RajaBanks. And I want to say again thanks to him, and giving him credit for that. So with that being said, let's start. So what are breakouts? So breakouts basically a breakout is an impulsive move in price that happens after price is in a consolidation phase. So usually that impulsive move would break support or resistance levels in the market. We will have examples later on that will explain more and will help you understand. So that's what a breakout is basically. It's just a very strong impulsive move in the market that breaks levels, which is either a support or a resistance level. A breakout happens when price is ranging in an area of the market, which is, like I said, it's called consolidations before. So that's when breakouts happen most of the time. So the phase where the market is ranging in a zone would be referred to as a accumulation or a consolidation phase. So that's what I was talking about. So we're gonna see like I said, graphs and examples that will be explained in detail. When price is at an accumulation phase, that means that price is collecting orders and volume to have an aggressive break. So what that means basically, when price is in a consolidation or accumulation, whichever term you want to use, price is usually collecting orders to push the price. Either it's a buy order, a sell order, whichever it is, the price is collecting at that moment of time. When the orders are being collected, volume becomes generated, and when volume is there, the move becomes very strong. So we're gonna see an example now. So as you can see, so we have this. So this is what I was talking about. That's a consolidation or an accumulation phase. So at this stage, you can see the price is collecting orders. So for example, some people will have orders here. They'll have, okay, I'm gonna sell it all the way at the top, and then it's the same here. People are just generating orders for the price to collect, for it to push. Some people will take buy, some people will take sell, so on and so forth. But price will only go in one way, whichever way that price has already said it's gonna go. As you can see here, this is an impulsive move, like we said here, an impulsive move. So this move is so strong the price didn't even give any confirmations for it to break. The only confirmation was this, that the candle broke, and that was the only thing you could use to trade it. But anyways, that's what I mean when I want to talk about impulsive move and consolidation. So we can see we have a support, this is a resistance. This is called a consolidation or accumulation phase, like I mentioned before, and that is the impulsive move or your breakout. Like I said before, it's a very strong move in the market. So we can see that here. Then how to trade them. So there's two ways to trade a breakout. The first one is going to be a safe, and the second one is going to be a little bit aggressive. So the first one is waiting for a retest, which is very explanatory. So you wait for the break, and after the break you wait for price to retest the level that it broke out of to take the entry. And the other way to do so is to take an impulsive move. Like I said, it's aggressive and high risk, high reward. So if you decide to use the impulsive move, please be careful, because it's a very aggressive way to trade. So how to trade a breakout or the retest method. So basically, it's safe. So I'm just gonna go about what are the benefits and the pros and cons of this strategy to do. It's safe. Won't fall. You won't be caught in a fake out. So basically, when price breaks and does the retest, the breakout is good, and price should keep moving in whatever direction it has broken. The risk management aspect of this particular way of trading is is very is very well is very well risk managed. Why? Because when price does a retest, it allows you to have smaller stop losses and stop losses below structures or above structures. So that's another good thing. But in impulse entries, it's a little bit aggressive. So the stop losses cannot be where you want them. Sometimes they become big. Sometimes they become very tight. So sometimes there's a little bit of problems there. Then we have high probability of trade to win, which is true. If you get a breakout, and then the price comes and retests and rejects that area, that means the higher probability of the price to keep moving in that direction for you to take a trade, and it's very highly that trade is gonna win. But the downside is that you might miss the trade. Why? Because sometimes you don't get the retest. Price just gets out and just keeps pushing. That is the downside of this particular way of trading. So we're gonna look at an example. So we can see that candles are printed now, which is just printed the way they are. We created a resistance here. The resistance was created on this bias. So when we see a blue candle and then a red candle, that's when the resistance is created, not like it showed here. It was a mistake, but the whole idea is that for price to create the level, you would need resistance. For it to form a resistance, you would need a bullish candle and a bearish candle to close next to each other like this, and that's when the resistance is being formed. Then here you have a support because you had a bullish candle here, then a bearish candle here, which both close at the same level, and that's where you end up having your level right there. And then price just keeps retesting these areas. So we can see here that there was a big wick. So this tells us that there's a rejection for this specific level. That means price could very possibly move up at this point. So let me erase this, and we're going to talk about this candle, and then we're going to move on. So this candle tells me that price has rejected the support. So what that says, that there's a very high probability that price is going to be moving to the upside because of this. And then we had the consolidation area, which is the whole area here. The reason for that is because it tells us now that, hey, we have been forming a lot of liquidity or volume, and we should be getting an impulsive move soon. So that's one thing to be looking at. So what happens next is this: we get a breakout, price pushes, that's your breakout. So two candles. So the first candle was the breakout. This candle was the confirmation for price to keep pushing, but you're now waiting for a retest, and this is your retest candle. So let me erase this. So this is your retest candle. So you can see that it went all the way to the zone, rejected, and came back and closed in this position. So closed where? Above the area. So that means your breakout and retest has been both confirmed. So it says the retest, and then you have candles printing after it. So at this point, it is up to you where to enter, because we can see the retest is here. We had the confirmation. Now it's up to you where to enter in these two candles. You could enter as soon as this candle starts forming. You can enter when the candle closes. You can enter anywhere. It's up to you, whichever confirmations you use. So the entry comes down to the confirmations you have. That's what it comes down to. So this is an engulfing candle, for example. You could enter just on that. You'd be like, okay, this candle is bigger than the previous candle, so you can say that this candle is bigger than this candle, and you could take a trade. So that's one way to take a trade. Or you could just get the retest, candle close, and then you just take the trade right away. But like I said, it's up to you. It's a decision you make on the rules you form around your trading strategy. And it says the entry area, which we spoke about. And this is another example. So support, the resistance. You see how big this consolidation area is? There's a lot of volume and liquidity being formed generated here. Then you have a very impulsive move, and like we said, that's impulsive move. And then you have, this is the initial breakout, the retest candle. So let me do this. So that is your breakout, the retest, and then this candle is an engulfing candle, like for the example I showed before. And then you should, okay, and then the entry should be anywhere you feel. So it could be here, or you could just wait for this support to be formed, and then you just take the trade. It's up to you. Like I said, it's something you should look for, and you should backtest, and you should have generated evidence that that strategy works for you. Now we're gonna talk about impulse entry, and like I said before, credit to RajaBanks and market fluidity. So I want to give them credit one more time, and with that being said, let's move on to the two impulse entries. So impulse entry is an aggressive way to catch a trade when there's no confirmations to take the position to trade, while candles are printing in your direction. For example, if you're looking for a buy position and candles keep on printing and there's no confirmation, so there's no retest, there's the Fibonacci doesn't match any of the confirmations we spoke about before, they're not there. This is where you use impulse entries, because you know the price is going to be moving towards you, and there are certain conditions for that to happen. We're going to be talking about these conditions soon. So impulse entries work when there is volume in the market, otherwise they become very risky. So that means when there is volume, what I mean when I say there's volume, when candles are printing, when there's big candles like this, that's when you know volume is there. But when you see candles like this, volume is not there yet. So when you see candles like this, that's when impulse entries become very, very risky. Why? The reason is because when you take an impulse entry, you are expecting price to keep pushing in your direction fast enough that you don't have any problems with anything. So you go from one point to the next very fast. But if price starts printing slow candles like this, that means there's a probability that the entry won't work, and it becomes very risky. So when there's no volume, the market is better, then you should just wait for confirmation. Like I said before, when there's no volume, it just becomes risky for you to take the position. To take impulse entry, there are certain things that you need to consider, which are certain criteria. So now we're going to be talking about them. So the first one is volume time. Like I said before, when there's volume, candles are bigger. When candles are bigger, impulse entries have a higher probability of working. Second one is candle formation. So the way the candle forms, it's very important. Some candles form without wicks, some candles form with long wicks. So you need to have a specific type of candle to form that is fit to you. There's nothing specific for impulse entry, but it's just something that you've seen, you've taken, that works for you. For example, I'm going to talk about myself here. For me, for an impulse entry, I need to see. Let's say we take in a buy position. Okay, this is the candle that printed before my trade. Basically, for me to take a trade, I would need the new candle that I'm going to be trading to form a lower wick, so that I can take a buy position. If I don't see this, I don't take the position. Why? Because this is something personal that I've seen, and if that doesn't work, then I don't take the trade. Like I said, if you need more information about this topic, you should go to Wicksdontlie's YouTube channel, which is going to be in the description. There's going to be a lot of information there about this topic. Like I said, candle formation, which is very important for me, and then break of the previous candle lows or highs, anticipating volume to push price further, which is very simple. I mean, it's self-explanatory. So if we're looking for sales, for example, so we have this bearish candle, then we have a printed bullish candle, okay, and then we created a resistance over here, and then we have another. So at this point we have created the resistance and the support, right? So at this point, what you would be expecting is that if you're going to be taking a sell, the price will break these lows for price to keep pushing down. If if that doesn't happen, then the impulse entry is not valid. So you expect this a wick to be formed. Doesn't have to. Don't quote me on this. Doesn't have to be a formal wick. It's something personal, and you have to look for that. Don't use what I use, because it's something that I have seen and I have taken. So you'll be waiting for the candle to break this low, to break this low and this low. So let me change colors. So you wait for the candle to break. Come on. So you'll be waiting for price to break these two lows, which are the wicks. The wicks are the lowest point of the candle. When price does that, then you take an impulse entry here for price to keep pushing down. There's a probability that the impulse entry works, there's a probability that it doesn't. And for it to work, you need volume. If there's no volume, there's a higher probability that it won't work. So this is just an example of what I mean, and there's going to be another example. There's going to be more examples later on. So that's the third condition. The other condition is that enough range in pips count. So basically, when you have the distance between a support and a resistance, you need a distance. You need enough distance that price could move in a range without having any problems. If you're gonna take a trade, if you're gonna take a trade in a 10 pip range, then that is very risky. It's not smart to do that. Why? Because if you take a trade, then you have to worry about your reward, which is going to be very small. Then the spreads you're going to be paying for the broker. So you have to have a specific range. So I'm going to show you an example now. It doesn't have to be this, but it's just an example to show. So we have a support that has been formed from the past. So that's why I have a support there. Then we have bullish candles forming, right? Then we have this candle. So let me change colors. So we had this bearish candle that wicked up and closed at this point. So at this point now we have a resistance forming. Then we measure this range from this support to this range resistance. It tells us that it's 35 pips. So now we know that the distance is very big and it's easier to trade in it. So then we form a bullish candle, and then we see here, yes, my support will be here. This will be my support for this specific 3 candles that will be taken. But the reason I don't put a support there is because I'm not waiting for price to break this, I'm waiting for price to break the wicks. When price breaks the wicks, that's what I'm looking to take a trade. So let's move on. So break here as the break of the previous lows will be, that's where you will basically take the entry. So price has to break this lowest point for me to take an impulse entry. If price breaks this candle but it doesn't break this, I'm not taking the trade. Why? Because the trade is not valid. The entry is not good. It's not an impulse entry at that point. It just becomes riskier because you don't have the confirmation that I just spoke about. So we can see candle breaks this low, then I take the position to ride it all the way down. It should work. Like I said, nothing's guaranteed in trading, but it's something that you have to see by yourself. I'm just talking about the concept and how it works. That's all I'm doing. You want to try it on your own responsibility, but look and see how it works and how it forms. So price over here created a wick. That's, for me, that will be very good. Then you can see that it pushed down to this level, it broke this low, and then my entry will be here, and I will try and ride it all the way down. Sometimes you get it all the way down, sometimes you get a breakout, sometimes you just stops at certain points. You don't know at what point it decides to stop, but that's the whole concept. The moment impulse entries work the best is when there is volume. And as we can see here, if you compare size of candles, let me erase everything. Let's compare size of candles. This. So it took 4 candles to go from the resistance to the support, but it took one big candle, to go from one area to the next. Why? Is because there is volume. When there is no volume, price is not good enough to to have an impulse entry for you to push from one area to the next. But when there's volumes, you can see big candles like these. When you see big candles like these, that's when you know price is good, price is doing what it is supposed to do. So that's an example of impulse entries. So let's move on to the next topic. Well, trade candle, which we spoke about. So here's another example. This is in a different way. So support, because we had history here on the left that was forming support. So anyways, so we can see that we're having candles painting. So at this point we'll have a support right here, right? A resistance, I mean. But let's keep pushing. So the reason I put my resistance here is because this is a fake out at this point. Why? Because on the left I had a support that was extended all the way here, but I didn't want to do it just yet. I just wanted for all of this to start printing. So at that point we have a fake out, like I just said. So when there's a fake out, it becomes a little bit complicated in a way to take a trade. So I'll explain why. So we have a fake out, and then we have our consolidation area. Every consolidation has an impulsive move, right? So now there's a different type of entry. So this is going to be the same thing as a breakout, and it's going to be an impulsive entry at the same time for two reasons. We're going to see why. So now we have a break, right? With that break, we can see the price is already at the top of this wick, but it didn't break yet. Candle closed without the break. So if the candle doesn't break, the trade is not good for an impulse entry. So that's something we need to patiently wait for. Now, look at this candle compared to these candles. That's volume. When volume is there, price will break and it will push and push and keep pushing. So as I said before, for impulse entry to work, you need to break previous highs, which is one here, one here. This candle respected the previous highs because there was no volume, so it couldn't break. The moment volume kicked in, which is in this candle, the big one, it broke this high easily and it just kept pushing, and the moment it does break the high, that's where you take the entry. If the break of this high doesn't happen, the entry is not good. Price has to break these levels for it to take an entry, for it to keep pushing up. That is the entry point. If that doesn't happen, you cannot take the trade, because the trade won't be good, and you'll be caught and you'll be caught in another fake out, which is going to be something like this. So this is going to be another example of an impulse entry. We've seen it again, and it's an impulse entry example. So support and resistance, like we said before. Then you have the consolidation phase or accumulation. That is the impulsive move, which is a part of a breakout, right? Now here's where an impulsive entry becomes. So you have this low and you have this low. Now the decision is up to you which low you want to pick. Do you want to pick this low, the riskier one, where the price could fake you out and come back in, or you want to wait for the candle to close and then take the impulse entry? Although you had the confirmation that price broke. So the first break was, so for example, if we're gonna wait for this candle to close, you might miss the trade, which is a fact. You might miss the trade. But the good thing about this is that you waited for the candle to close. So when the candle closes, you know that price is most likely that it's gonna be pushing to the downside. So that's one confirmation you have. So that's one thing. So now it comes down to where would you want to enter. So you could enter here, which will become your trading candle, which is up to you. That's the decision you have to make. Or you could wait for this. The moment the price, this candle closes bearish, you wait for this candle to form, the new candle, and you'll be like, you know what? I'll wait for this low to be broken, and when it does, I'll take the trade, and that will be trading candles. Like I said, it's very what's the word? I forgot the word. Anyways, it's very personalized in how to use impulse entries. You could use it here, you could use it here, or you could just be like, you know what? I got the close. I'm just gonna take the trade anyways. Doesn't matter if it's impulse entry or not. Just gonna take the trade just on the bias that you have a break of support. So that's something you could use and you could trade. So it's like I said, it's something personal in a way that you just have to see and use multiple times for you to know when it works best. What's important is that there's volume time. So regarding volume time, you can see it here again. So this is a big candle volume time, but it just couldn't break. Then we have all of this, which is all small candles. If you look at the size, they're very small, they're very minimum. The volume is not there, but this candle, big volume, meh, big volume. You see what I mean? There's big volumes in the market where price is just pushing strong. And these are things that you should be looking at. Like I said, volume is one of the conditions that you should be looking for when taking impulse entry. I mean that wraps up the lesson about breakouts and impulse entries. And I want to thank everybody that was here today. And I want to thank RajaBanks and Market Fluidity for letting me talk about impulse entries and share them with you guys and make a lesson about it. And with that being said, I hope hope everybody has a great weekend, and we'll see you on Monday, hopefully, or later today for the analysis. Have a good one.